The month of November is here and it's time to talk some stocks that I'm looking to buy this month. As I mentioned in previous videos, the fourth quarter is the best performing quarter for stocks, and it gets better with each and every month. November is typically better than October, and December is often better than November. However, this past month, the month of October, we saw the S&P 500 rise 7%. That is incredible growth for an index in just 1 month. Let's take a look at some of the highest weighted stocks that definitely pulled their weight for the index this past month. Tesla was up an insane 56% during the month of October. Microsoft was up 17.6%, Google gained 7%, and Apple was up 6%. And now when you look at weightings for the S&P 500, these four stocks make up 18% of the entire index. Now, how we're going to be able to beat the month of October, that may be a little difficult. But in today's video, I'm going to discuss 3 stocks that I'm looking to buy this month. Let's get started. Hey everyone, Mark Rusin here, back for another video. If you're new to the channel, make sure you hit that subscribe button down there as we discuss everything from investing to stocks, ETFs, REITs, anything that has to do with building wealth. We're going to discuss that on this channel. As always, before we get started, everything discussed in this video is for educational and informational purposes only, as I am not a financial advisor, so please perform your own due diligence. If you are looking for some free money, head down to the description down below where I have a link to M1 Finance. If you go to M1 Finance, click on the link and open a new account and fund it, they will give you $30 to get started with. Who doesn't love some free money? And to add on to that, you can head down and also click on my BlockFi link, which will give you some free Bitcoin to get started with new accounts. And also, if you could smash that like button, that'll help me immensely, as it's free to do, but it is such a huge help in growing this channel moving forward. All right, with that being said, let's get started on the top 3 stocks to buy in the month of November. All right, the first stock on my list is PayPal, stock ticker PYPL. For those of you unaware, PayPal is a fintech or a financial technology company that was acquired in the early days from eBay. When you were buying stuff on eBay, you would actually buy it or had the option to buy it through PayPal. But since then, the companies have split in 2015, and just recently has PayPal now come off the eBay platform entirely. However, PayPal has partnered with many consumers out there, and with the growth in online purchases even prior to the pandemic, whether you're making a purchase online to have shipped to you or to be able to pick up on store, PayPal is someone that benefits regardless. More recently, shares of PayPal have been under intense pressure, and over the past 2 weeks, news broke out that PayPal was potentially looking at acquiring Pinterest, the social media platform. And since then, shares have cratered 15% since the news broke, and they are down 20% over the past few months. PayPal is a company that is set to have huge growth. Management is expecting 20% top-line growth in the year 2022, with free cash flow expected to exceed $5 billion based on management's expectation and guidance. Turning to the stock, PayPal has a market cap of $271 billion, with a PE ratio of 56 times. But again, remember, with a growth stock, it's difficult to look at PE ratios because often if it's an ultra growth stock that maybe in its younger years, they may not have positive earnings yet, which would reflect a 0 PE. But in this case, the company has started to turn a profit and they have a very high PE ratio. But nonetheless, I like to look at metrics such as price to sales or enterprise value to sales to get a better idea of how the stock is trading on a valuation standpoint. PayPal currently trades at a forward enterprise value to sales multiple of 8.5 times compared to their 5-year average of 9.7 times. The company has a current 5-year PEG ratio, which takes into account the earnings growth, currently at 1.84 times. Looking at profitability, the company operates at a pretty decent profit margin of 20% and an operating margin of 17.7%. Another key to look at when doing your research on companies is return on equity. How is the company gaining a return based on their shareholder equity? In this case, PayPal has an ROE of 25%. Based on the company's most recent quarterly report, the company has $12.39 billion of cash on hand, which equates to a current ratio of 1.29. And again, a current ratio just tells us that the company has more current assets than it does current liabilities, which is often a very positive sign when looking at the balance sheet. Operating cash flow for the company is $5.7 billion, and the company has levered free cash flow of $4.46 billion. Next, let's take a look at what the analysts think of PayPal. Analysts currently recommend the stock as a buy with a recommendation rating of 1.8. That is taking into account a rating of 1 being a strong buy and 5 being a sell. Currently, 43 analysts have an average price target for PayPal of $325.93. Compare that to the current price of $231. That implies 40% upside from current levels. Again, PayPal has a lot going for it, and with the online and e-commerce businesses booming, whether it's not only just shipped to you, but also the more popular buy online and pick up on store. However you make your purchases online, PayPal is set to benefit. And this is one reason that I like the stock moving forward. The second stock on my list today is Facebook, stock ticker FB. Oh, wait. Or should I call it Meta? Just this past week, Facebook announced that it would be changing its name and its stock ticker as of December 1st from Facebook to Meta Platforms, and the new stock ticker would be MVRS, otherwise trying to indicate the metaverse, which is a key focus that we'll discuss here for Facebook moving forward. Facebook is another stock that has been under intense pressure, but unlike with PayPal, Facebook has been under pressure due to legal troubles. In the past few weeks, Facebook has had a whistleblower that's been testifying in front of Congress regarding the operations and the safety when it comes to their platform. The whistleblower has actually gone as far as to ask CEO Mark Zuckerberg, who is also the co-founder of Facebook, to step down from his position to allow the company to grow and to implement better safety strategies moving forward. There is no indication that Zuckerberg intends to step down from his position at all, so I don't foresee that coming to fruition anytime soon. But there is no denying that the platform that Facebook has built is not only popular, it is used on a daily basis, and for a lot of people, it is used on an hourly basis across the globe. They have built a strong advertising platform, but they are looking to do so much more with the company moving forward as it pertains to this metaverse. This metaverse play is something similar to what they're trying to build as an answer to what Apple has done with their iOS operating system or Google has done with the Android operating system. Looking at the company stock, shares of Facebook are down roughly 15% the past 2 months and are trading at a very attractive valuation. The company currently trades at a forward enterprise value to sales of 6.1 times compared to a 5-year average of 9.1 times. Facebook, or Meta Platforms, currently has a market cap of $917 billion. It has a PE ratio of 23.6 times on earnings per share of $13.97. In terms of profit margins, the company turns an impressive 35.88% profit margin and a 41.79% operating margin. In terms of ROE, the company returns 32%. Turning our attention to the balance sheet, the company currently sits on $58.08 billion and has a very impressive current ratio of 4.23. What this current ratio tells you is that the company has current assets that far exceed that of its liabilities. For the size of the company, it has very little debt, and it is a cash flow machine. When we look at cash flows, the company has recently brought in, based on the most recent earnings report, operating cash flow over the past 12 months of $53 billion and $26.47 billion of levered free cash flow. Looking at the analyst recommendations, analysts currently rate shares of Facebook or Meta platforms with a recommendation rating of 1.9, indicating the shares are currently a buy. These same analysts have an average price target of $403.74, which implies upside of 22% based on current share price. Short-term shares of Facebook could remain choppy just based on the freshness of this news and the legal troubles, but overall the company is maintaining a strong platform. There is no doubt the usage of Facebook across the globe is there. The advertising dollars are there, but what they are doing with this metaverse can be a game changer. Long term, if you're able to get in at this cheap valuation and be able to wait it out, knowing that you could see short-term choppiness just based on the freshness of this legal news, the company is building this metaverse out, and if you believe in the strategy, I believe that long-term shareholders will be handsomely rewarded. The third stock on my list today for top stocks to buy in the month of November is DocuSign, stock ticker DOCU. DocuSign is a digital transaction platform that allows users to not only sign, manage, and legally bind documents securely in a cloud environment. The company was certainly gaining traction early on, even prior to the pandemic, as more and more folks went to the cloud and went digital. But due to the lockdowns across the globe, businesses had to continue to operate, and businesses needed to continue to have legal documents signed. Now that we are coming out of the pandemic, you may see some softness in some of these high growth that are related to cloud or digital signing, like we saw it with Adobe, but they recently just bounced right off their support levels. And I believe DocuSign is just gearing up for a big run, because this is not just a pandemic play, this is a new age play. People are seeing the ease of signing documents digitally, being able to manage them digitally, being able to put them together digitally, and being able to keep them in a cloud environment that is not only reliable, but safe as well. DocuSign is referred to as a SaaS company, and you may have heard this term multiple times out there as it has become very popular. And think of it as a subscription-based company. It is a software as a service. That's what SaaS stands for. And with DocuSign, they have a wide range of products. It's not just you sign documents electronically. They've actually worked with, at least one time, 90% of the Fortune 500 companies. The company has a very large total addressable market, or TAM as you may have heard it referred to as, and they are just beginning their international expansion, telling you that the growth potential in a stock like DocuSign could be huge. Moving away from the business and more to the stock, DocuSign currently trades with a market cap of $54.68 billion. Now, the company hasn't turned a profit yet, as they currently have negative EPS, which means they don't have a PE ratio as of yet. Again, this is another reason with these high growth stocks why looking at price to sales or a metric like enterprise value to sales is a much more reliable valuation to take a look at. When it comes to DocuSign, the company has a forward enterprise value to sales of 20.68 times, which compared to their 5-year average of 25.55 times indicates that the stock is trading at a very intriguing valuation when just comparing this metric. Shares are currently trading about 11% off their 52-week high. The company has a current 5-year expected PEG ratio of 2.83 times, and when it comes to profitability, the company has a negative profit margin of 9.18% and a negative operating margin of 5.73%. Return on equity, or ROE, is also negative at negative 46.17%. Looking at the balance sheet, the company has $822.87 million of cash on hand and a current ratio of 0.98. What this tells you is that the company doesn't have current assets that cover fully the current liabilities. It's pretty much a 1-to-1 ratio, but being below a 1 rating just tells you that the current liabilities outweigh the current assets at this time. Looking at cash flow, the company has operating cash flow of $432.9 million and levered free cash flow of $701.08 million. In terms of the analysts, They currently rate the stock a buy, giving it a recommendation rating of 1.7, which is actually the best of the 3 stocks we've been looking at today. Those analysts give DocuSign an average price target of $324.02, implying upside of 17%. Now, DocuSign is not just a pandemic play. They've come off their highs because of some of those fearing that it was, but the company has an array of different products that are being used by Fortune 500 companies, and they're expanding on that. They're going international. So take a close look at DocuSign, because you're going to pay a little bit higher in terms of valuation, but the long-term growth is going to be there for you, in my opinion. So there we have 3 top stocks to buy in the month of November. We are following up a tremendous month that we saw in October. It's going to be real tough to beat that in November. But we, again, are looking for long-term investments. I'm looking to try and give you investments that have maybe been under pressure. Things like Facebook that has been under legal pressures, but they have a long-term goal. These are areas where you look to pounce as an investor. So in the comments section below, let me know what you think of these 3 stocks. Do you own any of these 3 stocks yet? Are you interested in owning any of these 3 stocks yet? I would love to hear from you down in the comments section below. And if you haven't done so yet, and if you enjoyed the video, again, please hit that like button, as that is huge for the growth of this channel moving forward. I hope you enjoyed the video, and we will see you next time. Take care, everyone.